Here's something that's going to genuinely surprise you. A huge piece of silver's recent slide has almost nothing to do with silver itself. It has to do with Nvidia, with Micron, with a $2 trillion question mark hanging over the entire artificial intelligence industry. Wall Street is in the middle of one of its sharpest tech stock sell-offs of the year. And silver, sitting quietly in a completely unrelated corner of the market, is getting dragged down as collateral damage. Today, I'm going to show you the actual mechanics of how a chip stock crash thousands of miles away from any silver mine ends up pushing silver's price lower, with real names, real numbers, and a real explanation of why this keeps happening every time stocks get scary. This is genuinely one of the most overlooked stories behind silver's recent weakness, and almost nobody covering this metal is connecting these dots properly. Let's get into it. This is OG Silver Stacker. Every video, a new piece of the puzzle. Let's go. Let's start with the tech story itself, because you need to understand what's happening there before the connection to silver makes any sense. Now, over the past several trading sessions, the Nasdaq Composite has dropped sharply, falling more than 2% in a single session at one point, with the broader S&P 500 dragged down alongside it. The epicenter of this sell-off has been semiconductor and memory chip companies specifically. Micron Technology, a major memory chip manufacturer that had been on an absolutely astronomical run earlier this year, tumbled more than 10% in a single session, with shares briefly dropping even further before partially recovering. Other chip names got hit hard too, Qualcomm and ARM holdings each falling close to 9%, and SanDisk dropping nearly 12%. This wasn't a purely American phenomenon either. The sell-off actually started overseas, with South Korea's chip-heavy stock index falling nearly 10% in a single session, dragged down by major memory chip producers, whose shares fell more than 12% each. This is genuinely significant because it shows the selling pressure wasn't isolated to one country's market sentiment. It was a coordinated global reassessment of an entire sector that had been running extraordinarily hot. So what actually triggered this? The core issue boils down to a serious, growing skepticism about artificial intelligence spending. The combined capital expenditures across just 4 of the largest technology companies, the ones building out massive AI infrastructure, have now exceeded $450 billion for this year alone. That is an almost incomprehensible amount of money being poured into data centers, chips, and computing infrastructure. Investors who had been cheering this spending as a sign of unstoppable future growth are now starting to ask a much harder question: whether all that spending is actually going to generate returns anywhere close to justifying it. When a market that's been climbing on pure optimism suddenly starts demanding proof instead, that shift in mood can trigger exactly the kind of sharp, fast sell-off we've been watching unfold this week. Now here's the part that connects all of this directly to your silver position. And it's genuinely one of the most underrated forces affecting your precious metals prices during periods of broader market stress. When large institutional investors, hedge funds, and multi-asset portfolio managers experience significant losses in one part of their portfolio, like a tech stock holding that suddenly drops 10 or 15%, they often need to raise cash quickly to meet margin requirements, rebalance their overall portfolio risk, or simply reduce their total exposure across the board during a period of heightened uncertainty. Here's the crucial detail that explains why silver specifically gets caught up in this. When a fund needs to raise cash fast, it doesn't necessarily sell the asset that's actually causing the problem. Sometimes the losing position is illiquid, or the fund manager believes it'll recover and doesn't want to lock in losses by selling it. Instead, funds often sell whatever assets are easiest to sell quickly without moving the price too much against themselves. And that frequently means selling their most liquid, most easily tradable holdings, which commonly includes precious metals positions, including silver futures, silver ETF shares, and gold positions, even though those metals had absolutely nothing to do with the original problem in the tech sector. This is sometimes referred to as a liquidity cascade, or correlated selling, and it's one of the most consistent patterns observed during periods of broad market stress throughout financial history. We actually saw direct evidence of this exact mechanism playing out this week. Gold futures dropped below $4,000 an ounce for the first time in roughly 7 months, with reporting specifically attributing that drop to the broader stock market slump triggered by the tech rout. If gold, which is supposed to be the ultimate safe haven asset, the thing people buy specifically to protect themselves during stock market turmoil, is dropping because of a tech stock sell-off, that tells you just how powerful this liquidity-driven selling mechanism can be. It temporarily overrides even the normal safe haven relationship that gold is supposed to have with falling stock markets. Here's where understanding silver's specific characteristics becomes really useful, because if both metals are getting caught up in the same liquidity-driven selling, you'd expect them to fall by similar amounts. They didn't. And the reason connects to concepts we've discussed before on this channel, but applied to a brand new situation this week. Silver, carrying a higher beta relative to broader market stress compared to gold, tends to experience amplified moves during exactly these kinds of liquidity-driven sell-offs. Part of this comes down to silver's smaller overall market size compared to gold, meaning the same dollar amount of forced selling has a proportionally larger impact on silver's price. Part of it comes down to silver's dual identity as both a monetary and industrial metal, which we've explored in previous videos, meaning silver gets hit by both the liquidity-driven selling affecting precious metals broadly and by a separate wave of concern about industrial demand if investors start worrying that a broader tech-driven economic slowdown could eventually dent manufacturing and electronics demand for silver specifically. There's also a more technical reason worth understanding. Silver futures contracts require less capital up front to control the same dollar value of exposure compared to many other assets, a concept called leverage. This makes silver an attractive instrument for traders looking to quickly adjust their overall portfolio risk exposure during a fast-moving, stressful market period, because they can establish or close out a meaningful position without needing to deploy as much capital as they would for an equivalent size position in many other assets. This higher capital efficiency cuts both ways, though, meaning silver can see outsized selling pressure relative to its actual market size during exactly these kinds of rapid, stress-driven deleveraging events. Let's add another crucial layer to this story, because the tech sell-off and silver's weakness aren't actually two separate coincidental stories happening at the same time. They're deeply connected through a single underlying thread: interest rates. This week, one of the largest global investment banks published research suggesting the Federal Reserve could potentially raise interest rates 3 separate times before the end of this year, a notably more aggressive forecast than what most of the market had been pricing in previously. This matters for tech stocks because of how their valuations actually work. Many of the largest technology companies, particularly those leading the AI infrastructure build-out, are valued heavily based on expectations of enormous future earnings growth many years down the road. When analysts calculate what those future earnings are actually worth in today's dollars, a process involving what's called a discount rate, higher interest rates make that calculation produce a lower current value. Because money expected far in the future becomes less valuable today when interest rates are higher. This is exactly why aggressive rate hike expectations hit growth-oriented tech stocks particularly hard, often harder than they hit more traditional, steady earnings businesses. Here's the connection back to silver. We've discussed extensively in previous videos how higher interest rate expectations also directly pressure silver's price. Because silver doesn't pay any yield, making it less attractive relative to interest-bearing alternatives when rates rise. So this week, the exact same underlying catalyst, an increasingly hawkish Federal Reserve outlook, is simultaneously crushing tech stock valuations through the discount rate mechanism and crushing silver's price through the opportunity cost mechanism. These aren't two unrelated stories happening to collide by coincidence. They're two different symptoms of the exact same underlying disease, a market rapidly repricing for a higher interest rate environment than it had previously expected. Let's bring in one more piece of confirming evidence, because I think it's important to show you that this isn't just a theory I'm presenting. It's something visible across multiple independent corners of the financial markets simultaneously. The yield on the 10-year U.S. Treasury note, a key benchmark interest rate that influences borrowing costs throughout the entire economy, climbed from around 4.4% to 4.6% over the same stressful period. Rising Treasury yields during a stock market sell-off is actually somewhat unusual behavior worth pausing on. Normally, when stocks fall sharply, investors often rush toward the safety of government bonds, which typically pushes bond prices up and yields down, the opposite of what we saw here. The fact that yields rose instead, even as stocks were falling, tells you that the dominant force driving markets this week wasn't simple fear and flight to safety. It was a genuine repricing of interest rate expectations, with investors increasingly betting that the Federal Reserve is going to keep rates higher for longer than previously anticipated. That specific dynamic, rates rising because of hawkish Fed expectations rather than falling because of safe haven demand, is exactly the environment that tends to be most punishing for an asset like silver that doesn't pay any yield of its own. Let's go a little deeper into the actual substance behind this tech sell-off, because understanding it properly helps you gauge how long this particular pressure on silver might realistically last. The core tension driving this entire episode is a question about return on investment. Major technology companies have committed to spending an absolutely staggering amount of money this year building out artificial intelligence infrastructure, data centers, specialized chips, and computing capacity, and investors are increasingly demanding to see concrete evidence that this spending is actually translating into profitable, monetizable business results, rather than just impressive-sounding capability demonstrations. There's also been notable turnover of high-profile AI talent moving between major technology companies and competing artificial intelligence labs recently, which some market participants have interpreted as a sign of instability or uncertainty within the sector, even though talent movement between competing companies happens constantly in any hot, fast-growing industry and doesn't necessarily signal anything fundamentally broken. Combined with the sheer scale of capital expenditure now exceeding $450 billion across just a handful of companies, the market is essentially demanding a much higher standard of proof, before continuing to reward this spending with ever higher stock valuations. Importantly, several market analysts have specifically characterized this episode as a healthy correction within an ongoing bull market for technology and AI stocks, rather than the beginning of some kind of broader bubble collapse. One analyst specifically noted that after such a sharp, sustained move higher in tech valuations over recent months, a period of consolidation and reassessment is a completely normal, even healthy part of how markets function, rather than a sign that the underlying AI growth story has fundamentally broken down. If this characterization proves accurate, that suggests the liquidity-driven pressure currently weighing on silver through this specific mechanism could prove temporary, easing once tech stocks stabilize and large funds no longer need to raise emergency cash by selling unrelated, liquid assets like silver. Let's put this specific dynamic, unrelated asset classes getting dragged down together during a liquidity crunch, into proper historical context, because this isn't some brand new, never-before-seen phenomenon. During the depths of the 2008 financial crisis, this exact same correlated selling dynamic played out dramatically across nearly every asset class simultaneously. Stocks, commodities, real estate, and even gold all fell together during the most acute phases of that crisis, specifically because panicked, leveraged investors were selling literally anything liquid they could find to raise cash and meet margin calls, regardless of whether any individual asset's own fundamentals actually justified that selling. We saw an even more compressed, dramatic version of this same pattern during the initial pandemic shock in March of 2020, when silver actually fell even harder than gold over a period of just a few weeks, specifically because of the same liquidity-driven, correlated selling dynamic, even though nothing about silver's actual long-term supply and demand situation had changed at all during that brief, panicked window. The consistent lesson across all of these historical episodes is that liquidity-driven, correlated sell-offs tend to be sharp, but relatively short-lived, compared to sell-offs driven by genuine, fundamental reassessments of an asset's actual long-term value. Once the acute pressure passes, meaning funds have raised whatever cash they needed and market conditions stabilize, assets that got caught up in this kind of indiscriminate selling without any change to their own underlying fundamentals have historically tended to recover that lost ground relatively quickly, precisely because the selling was never actually about silver in the first place. Given everything we've covered, let's get practical about exactly what signals would tell you that this particular source of pressure on silver is fading. Separate from any of the other factors we've discussed in previous videos. Watch whether the tech sell-off itself stabilizes. If chip stocks and broader technology names stop making fresh lows and start consolidating or recovering, that's a strong signal that the acute phase of forced, liquidity-driven selling across asset classes is likely passing, which would remove this specific source of pressure on silver's price. Watch whether gold recovers back above that $4,000 level we discussed earlier. Since gold dropping below that level was specifically attributed to the same broader stock market stress rather than anything gold-specific, gold reclaiming that level would be a meaningful signal that the correlated, liquidity-driven selling pressure across precious metals broadly is easing. Watch Treasury yields specifically. If that 10-year yield we discussed continues climbing meaningfully higher, that suggests the market is still actively repricing for a more aggressive Fed path, which would continue to pressure both tech stocks and silver simultaneously through the mechanisms we walked through today. If yields stabilize or pull back, that would suggest the market has largely finished pricing in this more hawkish scenario, removing pressure from both asset classes at the same time. Let's bring this together into something genuinely useful for how you think about your silver position, given everything we've covered today. Recognizing that a meaningful portion of recent silver weakness is connected to forced selling completely unrelated to silver's own fundamentals should change how you interpret this specific stretch of price action. This kind of liquidity-driven selling, by its very nature, doesn't reflect any genuine reassessment of silver's underlying supply deficit, industrial demand growth, or long-term structural story that we've covered extensively across previous videos. It reflects funds needing cash quickly, and silver simply being an easy liquid asset to sell in that moment, regardless of its own merits. Understanding this distinction matters enormously for how much weight you should put on this particular stretch of weakness when evaluating your own long-term thesis. That said, I want to be balanced here, exactly as we discussed in a recent video about being honest with yourself. This liquidity-driven selling pressure is layered on top of other genuine fundamental pressures we've covered. The hawkish Fed outlook, the strong dollar, and broader uncertainty about the durability of recent geopolitical de-escalation. This tech stock connection explains one meaningful piece of recent weakness, but it's not the only piece. And you shouldn't treat it as a reason to assume silver definitely bounces back immediately just because this particular mechanism eventually fades. So here's the real story behind one of the most overlooked pieces of silver's recent weakness. Wall Street's tech stock sell-off, driven by serious questions about whether $450 billion in AI spending is actually going to pay off, triggered a wave of forced liquidity-driven selling that spilled directly into precious metals, including silver. Even though absolutely nothing about silver's own fundamentals has actually changed. We saw direct confirmation of this mechanism in gold's drop below $4,000, in rising treasury yields during what should have been a flight to safety moment, and in a hawkish Fed rate forecast that's simultaneously crushing tech valuations and silver's appeal through two completely different but related mechanisms. This doesn't mean silver's other challenges, the strong dollar, the Fed, the geopolitical uncertainty we've covered in previous videos, have disappeared, but it does mean that at least part of this recent pain has nothing to do with silver itself. And understanding that distinction matters for how you think about your own position going forward. If connecting dots between tech stocks and silver is the kind of analysis you didn't expect from a precious metals channel but actually found valuable, hit that like button, subscribe so you catch the next breakdown, and tell me in the comments, did you already suspect tech stocks were dragging silver down, or is this connection completely new information for you? I read every comment, and I'll see you in the next one.